Joining me now on Staying Ahead of the Curve is Chief Market Strategist for Voya Financial, Doug Cote. Doug, thanks for joining us on the Curve today.
Thank you, Jeff. It's a pleasure to be here with Comac Retirement Group.
So we've had about 6 to 9 months of extreme market volatility. We're almost through the first quarter of 2016 and want to get your assessment of what's going on in the markets and what you're seeing as a financial firm.
Well, there's been three drivers of risk in the markets. There's been certainly oil, the most pervasive risk factor. There's been China, the second largest economy in the world, and there's been central banks who have trying to stimulate and have not been successful. But you also have the fundamental side. The American economy is doing fairly well, and unemployment is doing well, and actually is dropping. And I think investors need to focus on that. We're constructive on the market, and you have to be broadly diversified to build a wealth-producing portfolio.
So you mentioned the term investors. Our firm is working primarily with large retirement plans, defined contribution plans, 401k, 403b, 457, and we work primarily with employers who sponsor these programs. What's your assessment in terms of working with a retirement plan on the market and selecting asset classes for the retirement program?
Well, first you have to have a plan. The plan has to be, what's your investment process? It has to be broad global diversification. It has to be the weighting of the asset classes. And you have to have a plan of what to do when there's volatility. Do you stay the course? Do you adjust? Do you go defensive? But this has to be well laid out in a prudent plan before volatility happens. When the markets start to hit, then you stick to the plan. Whatever the plan is that's how investors will build wealth. What happens is investors tend to get, we call it the folly of gaming diversification. They diverge from the plan, they're undisciplined, and what happens is they tend to get whipsawed by the markets. We say that's not the way to build long, sustaining wealth.
And I think we're in agreement, the investment policy statement is key, but also having a prudent process and following that. And we've seen that actually in recent fee litigation and other litigation around retirement plans. You got to have a process, follow it soup to nuts to ensure success. Changing gears a little bit, you mentioned the global markets in China. I want to get your assessment of what we have seen in terms of a slowdown in the productivity of China and the impact on the global markets.
What China's been doing that's creating uncertainty is they've been having their foot on the accelerator and the brake pedal at the same time. That has the market's concerned that maybe things are worse than they're portraying in their 6% or 7% growth rate.
So in terms of building a portfolio for a retirement plan participant, it definitely includes emerging markets and global stocks.
Yes, what we like is a broadly diversified portfolio. We start with home bias of U.S. domestic equity, large, mid, small. We'll add international, the Europe and Far East index. We like emerging markets because we are in a global economy, and by putting a volatile asset class like emerging markets into a portfolio, it's really, you can actually increase return and reduce risk. It's not the characteristics of that single asset class, what it brings to the portfolio. And I think a lot of investors don't understand that. And even better for risk control is the bond side. Then you have a portfolio that really mitigates risk while building wealth.
Changing gears, you mentioned rising rates. The Federal Reserve met recently, raised rates quarter point. We're expecting up to 4 this year in 2016. Want to get your assessment of where things stand today with the Federal Reserve.
Well, I call Fed Chair Janet Yellen a hawk in dove's clothing. And I think she's actually been doing a very good job of getting us to normalize the interest rate environment. She got us off QE3. That was an $85 billion a month program. She ended that. That was important. That was a tightening. And then she got us off what they call a ZIRP, zero interest rate policy, by raising from zero 25 basis points. That got us off ZIRP. That's normalizing. Going into this year, there was an expectation of 4 rate increases to about 1%. That's not going to happen. We've ratcheted that down, really due to the volatility in the global markets in the beginning of the year, primarily driven by the collapse in oil. But oil has been rebounding of late, and that has brought confidence back to the markets, and we're seeing good signs in the American economy with unemployment, jobs. It's all about jobs, jobs, jobs. If Americans are working, they'll spend.
So in terms of rising rate environment, obviously within a retirement plan, this is a long-term investment. Are there specific asset classes that, typically we see core fixed bond as an example, maybe some high yield, maybe world bond is what we're seeing within our clients' portfolios. Are there other asset classes that you might think within fixed income that make sense to include in a retirement plan?
I would add Ginnie Mae. Ginnie Mae is a safe government bond, and I agree with the other asset classes you talked about, like global bond and high yield. I think they're diversifiers, and they're really the ballast of a portfolio so you can own a lot more equities.
Lastly, 2016 is a presidential election. We have the full Congress up. We have two-thirds of this, or a third of the Senate up. I want to get your assessment of the presidential election, the primary season, and also the uncertainty that is around that. We don't know who the next president's going to be. There's a process that we have to follow. But how do portfolio manager teams build in that uncertainty into their investment process?
Well, Americans really love their politics, but what we say is don't Washington-proof your portfolio. It's folly to do that, and the private economy has to be successful and make corporate earnings regardless of who is in power. So it's hard to predict how this will play out. So don't play it.
So don't play it. So it's really kind of isolated to your investment process.
Yes.
Doug Cote, thank you so much for joining us on Staying Ahead of the Curve today.
My pleasure, Jeff.